Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, February 18th, 2022. It's 11:51 Eastern Time as I'm starting the video. Wanted to get one out to you early today. Nothing major new, but I just wanted to reiterate, where I think we stand in the markets. And again, I want to talk about the potential for a possible market crash. I won't mix words. That's the warnings. The warning signs have been there. I've talked about extensively, and the technicals are there. I'll speak real quick. Somebody mentioned the other day to me, Randy, what are your thoughts on Ukraine? Geopolitical events. And I think I already commented on that in one of the videos. If not, look, I honestly don't know. That's not my wheelhouse. I'm not an expert in geopolitical events, but I can say that I do believe it's to an extent, to a greater or lesser degree, somewhat of a distraction. I watched the futures. I watched them pop last night, only to get faded this morning on every little potentially positive or negative headline coming out of there. Troop movements, airplane flybys, hostilities there, potential talks now between the U.S. And look, okay, is it a real thing? Yes. Does it have the potential to either roil the markets or spark a sizable rally? I will say this: I do think the downside, based on what my analysis of the charts and factoring that in, I think that the RR risk reward ratio skews to the downside if there was something that really got heated over there versus if the headlines start going to the way of, well, Russia's not going to invade, they're going to back off, peaceful resolution, all that. That's my opinion. Again, I trade the charts. I can sit here all day long, and you can hash through it, and you can listen to 1,000 pundits on TV give you their take on it. But I do want to say that the most important thing here is, again, if you want to use that, factor that in at all. My takeaway is what it's doing. If you are assuming that that's what's keeping the markets down recently, and stalled out that rally that we had off the recent lows. Well, what happens? This is a 60-minute chart or 2-hour chart. I'm gonna loop back to that, but I just want to go into the longer term charts and tell you what I can say with fact, not just opinion. And that is what it does is when you're in a strong uptrend, as the market has been since the lows back when COVID first hit and the March lows, tremendous amount of money and stimulus thrown into the markets and the economy, you have strong upward momentum. And so what I'm looking at here is the PPO, price percentage oscillator, very close cousin to the MACD. It's a momentum indicator, one of my favorite. There's multiple uses for it, divergences, bullish and bearish crossovers. You can look at the histogram divergences, where those lines are relative to being above or below certain levels. And again, so I have multiple uses on just this one indicator alone on many different time frames. Now, where I'm going with that is what it does is when you're in a strong uptrend, and you don't have to go down to get a bearish crossover because a momentum, think of it as throwing a rock up in the air. It's going to go. There's a rate of deceleration. Eventually, it hits a point of zero acceleration or deceleration where the rock is just stationary for a second, then it comes back down. Now, bear with me. So when you have that upside momentum on the indicators, even if you turn around and stop going up, only trade sideways, the momentum has then shifted. And so the longer we grind around here, the more it solidifies this. And all I can say, if you don't believe in technical analysis or the value that it has in trading and investing at this point, there's no reason you should be here or listening to my voice. But what I can say with certainty is that it causes certain technical events, bearish technical events, such as, I've talked about it for quite a while here, these PPO crossovers on the monthly chart of the S&P 500, here SPY. And so again, the longer it takes, even if there is a positive resolution, you're going to have now with its February 18th, so we've got just over a little more than a week, 10 days or so left in the month. And so it's going to take quite a bit. It is possible, but to undo this bearish candle, remember, we already had solid confirming monthly crossovers already happened. So those are check marks that at this point, look, anything's possible can be undone, but they've already solidified. Let me just tell you what I'm talking about here, show you what I'm talking about there. Last month, that was a confirming red bar on the histogram, meaning we had a solid confirmed crossover in the monthly time frame. This month, it would take some type of super crazy rally to undo the second in confirming bar on the histogram. And again, I've already done this many times, associated all the drops, and they range pretty high double digits. 31, 24, 26, 13, 16, 55, 18, 84% with zero exceptions, 29 and 20. Those are all the drops associated with when the monthly histogram went red and finalized a red print. So there it is. So you already have it. It's in play. And the S&P was just the last to break. And there it is, IWM last month confirming. This month even deeper in the red, indicating more downside likely, no guarantees. And then, of course, as I said, the market, if you want to call it that, the S&P 500, the probability is we're going to get that. And then you say, oh, well, sure, Randy, we had a correction. Well, so far it's been about a 12% correction, and that doesn't jive with these other drops. We did have a 15%er back here, I'll give it that. And so it is possible this goes down in the record books as the most mild correction associated with a bearish crossover on the monthly time frame on the PPO of SPY. Possible, but improbable and unlikely. Okay, because these are the averages, and you can take your calculator out and do the averages, and also look at where we are in the economic cycle. We're in what is unarguably, at least in my opinion, one of the biggest bubbles in history as far as it's the everything bubble. I've used that term before, and now I've heard other people use it. It's housing market bubble. We see commodity prices surging, the euphoria and the bubble in the stock market. Again, I've been around quite a while. I was very active. I was, in the business as a financial advisor, stockbroker during the dot-com bust and the boom, throughout the entire boom in the 90s. And I see similarities when I see the Reddit groups and the what do you call it, Robinhood crowd, cryptocurrencies. It's the dot-com bubble all over again, especially with the massive participation in retail traders. That was a signature. I clearly remember back in the 90s leading up to the dot-com bubble, and that's when we had the biggest drop. And bigger the bubble, the bigger the drop. There was your bubble in the NASDAQ 100. It was even bigger in the NASDAQ composite, but even then the NASDAQ 100, the largest, most solid companies in the NASDAQ composite, the top 100, they fell 84% from high to low. So all I'm doing is just trying to tell you there's a lot of similarities, and forget about whether we're going to have some much bigger drop. You know where my targets are. As of now, I'm just looking for a mean reversion to pull back to the primary uptrend line, which is still, as of today, and I've been harping on it all along, so I've harped on it here, but they're still, assuming I'm right, and that's where we're going, at minimum, is about a 20, depending when we get there, another 20% downside. And again, I sound like a broken record if you're a subscriber and you listen to these videos every day, but I think if I am right, I think the odds are very good that it's going to be a very quick swoon down. What to look for over the next couple weeks, if I'm right, circuit breakers being triggered, all kinds of opinion. I tune out the noise. I don't turn on the social media. I just do my own thing. I bury myself in the charts. I read news. I read headlines, but I don't listen to opinions of others. If you're new to this, it's gonna cause paralysis by analysis. You're gonna have the bulls come out, and you're gonna have the Johnny come lately bears, and then you're gonna have the perma bears that they'll march out that have always called for big drops like this. But all I can tell you is let's trade the charts. Let's not get tied up in the noise and what's going on with Russia, Ukraine, even here in the U.S. Those things, they do matter in the long run, but in the short term, especially in this, I give you my word on, again, from experience, when during periods of very sharp, especially corrections, even more so on rallies, but during corrections in the stock market, especially impulsive ones, technicals rule the roost because fundamentals are changing so rapidly. The analysts out there on Wall Street, they can't process, they can't factor in. And first of all, they're clueless. They drive in the rearview mirror, in my opinion. They make forecasts based on current assumptions and trends. But as I've talked to you about before many times, I think what many fail to realize, and they probably can't see this. Number one, they don't see the potential for the swift drop that I do, and how far down we're going to go. And then even if they did, they need to factor in what does that do to consumer sentiment, psychology, and actual outright buying power. The wealth effect is a tremendously powerful thing, and the amount of wealth created since COVID hit, it's staggering. Here's this is COVID right here. From the lows, again, taking the lows, but let's just even go where the market was before COVID hit. Let's just even play that game. And you're still up with all the excessive stimulus, about 75% in the NASDAQ 100. You want to go a little bit more real number, a little temper it down a little bit. Let's look at the S&P 500 because not everybody was all into tech stocks. NASDAQ still 42%. An impressive number, and then off the lows about 115%. And it was this and the stimulus, not just the stock market boosting consumer confidence and spending, but outright checks being sent out to nearly every American. Spend this, businesses being thrown money even if they didn't need it. And it again was the most, it'll go down in history as one of the most, I believe, overdone stimulus, both from fiscal and monetary, both from the Fed and the federal government. Again, that's my opinion. It's hard to argue the impact that it had. And again, technicals, here we are. We're sitting right there on that support shelf. This is the support shelf I've been talking about. And this is it. So I just wanted to, even if I sound repetitive, not just for those maybe long worn of the risk of a sudden and very powerful swoon down in the markets, but also, so those of you that might be concerned might want to lock in a lot of the profits you made in 401ks, but there's also those that want to profit. And again, I talk about this often, the beauty of trading corrections and short selling in general. Now, I will say you have to be a much more adept, much more nimble than long side traders, because you got to get in right. You got to get the timing right, and most importantly, you can't stay too late to the party, because once corrections and bear markets are over, the reversal is usually very fast. But again, that's where kind of my niche is. I trade corrections, I trade pops, breakouts, rallies, and again, I've identified some levels where we can either take profits or lower stops if you want to ride it down in case we get a really ugly crash that could exceed my my price targets, or at least I doubt my my final target right now would be exceeded anytime soon, but that's possible. Anything's possible. Also, I'll mention if you want to check this out, Peter Eliades has a YouTube channel, Stock Market Cycles, and he posted the last two videos. If you want to check out his page, he posted some analogs that are pretty interesting to the crash of 1929 and the crash of 1987, incorporating both technical analysis as well as lunar cycles. That's interesting. There's some famous technicians out there, such as Arch Crawford, I believe he's retired now, who've used astrology and lunar cycles to pretty accurately predict some big moves in the market. So look, it is not my cup of tea, and Peter Eliades, although he's very adept in technical analysis, his primary thing is cycle trading, and I certainly respect that, understand, and think there's something to that. It's just not my wheelhouse. But again, he goes over the similarities between now, 2000 and or 1929 and 1987. The only thing I'll go to say on that, and he talks about how quick things dropped after the full moon, which we just had. Where we're pretty much right there now, is that just so you know, 1929 and 1987 cannot happen again, at least not as fast as they did, because of what I just said a second ago. It was 1987 that caused, after that, they started implementing circuit breakers into the stock market, which means it can only fall so much so fast before Number one, they come in with the initial rounds, and then what they do is you can only sell on an uptick, so it slows down the selling. If things keep getting ugly, they'll shut the market down for a while, cool down period, and if things get really, really bad, then they shut it down for the rest of the day. So, but all that does, just so you know, it just slows the inevitable. I am a firm believer that the market is going to go from point A to point B. If the charts indicate point B is likely, it's just a matter of how long is it going to get there. And so what they've done is implemented circuit breakers, and in my opinion, that's only going to serve to possibly slow things down. So therefore, we might not get, in other words, I'm going from memory, I think in 1987 was like a 21% single day drop in the Dow. And again, that cannot happen again, simply because of the circuit breakers will not allow it. They'll shut the exchange down for the rest of the day, the market, if need be, if it gets drops too much too fast. Okay, so I don't want to get too far ahead of myself, and we may be laughing about this next week, next month, if the market turns around, blasts off to new highs. I don't mean to, I'm not sounding wishy-washy if I tell you, if anybody that does anything less than say anything is possible, really, I would tell you, run, don't walk away from that analysis. I talk in probabilities, and because possibilities, like I said, anything's possible. Just about anything's possible. But anyways, here's what to look. We got a little bit of divergence there. We have some support. This is the old 23.6 fib. It's not great support, but I do want to say that we've taken out that recent low. This is, I'm sorry guys, I should have mentioned what I flipped to here. ES, the S&P 500, 120-minute candles. And so there it is. We just took out the recent low right there. If we can build on that today, and I think we can, here's what I think, and this is just fundamental ramblings, kind of short-term prediction or guessing. Okay, let's say no headlines come out between now and 4 p.m. today revolving Ukraine and Russia. Well, you got to think, okay, right now the markets are spooked. We're in distribution mode, number one. First and foremost, recognize a trend, and therefore, when you recognize a bullish or bearish trend, you have to give the benefit of the doubt to that trend. So let's just say you've got a subset of traders, everybody participating in the markets. Are they want to go home long, or would they want to maybe reduce long positions? So therefore, I'd like to see, and I believe we can see, a nice red close today because of that, because you have the extra 2 days of overnight risk heading into the weekend. And then, and I've been talking about it for a while, and just warning the possibility of that quick swoon down. If it's going to come, nothing would be better. I'm not saying it must happen or will, but I think it's likely. Nothing would be better than a nice fat gap down. Big slide over the futures. I don't care if it's news induced or not. It doesn't really matter. And that would be a big swoon down. Let's go back to the daily charts here. So you had the bottom of, let's go to my weekly charts so you can see my targets. There they all are. T1 already hit with the bounce. So a big old gap down would be beautiful, because for the reasons I talk about, it does two things. It traps longs, those that are, full of hopium right now, that everything's going to be hunky-dory. Russia will, go back home, tuck tail, pull out the troops, and the market's already digested what the Fed needs to do, et cetera, et cetera, et cetera. And that's possible. Look, when you're short, especially heavily short, there's always a possibility of a big gap up, and you need to factor that in and make sure that you have, I always say in investing and trading, sell down to the point at which you can sleep at night. And that's it. So just know this, that when volatility is high, the odds of a sizable gap, especially over a weekend, are increased and elevated. So when I say sizable, it could be 3% or more in either direction. Do the math on your positions, see if you're okay with that. To me, everything's about risk and reward. I'm also playing the long game on the positions I'm speaking to right now, meaning, long-term trend trading, looking at these next targets down here. And so, to me, it's worth the risk. You'll have to decide that for yourself. All right, so a nice gap down, back to what I was saying, will do two things. It will, A, trap those longs, and that's just signature of a bear market and a correction. They start feeling more and more pain, and then they start to reach at once. A lot of stops hit that capitulation, and that's what causes those quick swoons down. So far we had a pretty impulsive leg down before with that leading into that bear flag, but again, we should probably have something bigger next week, I would say. And the other thing it does besides traps those longs is it denies objective short entries to what I call wannabe shorts. Those that maybe they're textbook traders, the ones that say trade only the charts, what you see in front of you, and they want to wait for a break of the recent lows, 342. Well, if we gap down 4% on Monday morning, they're not going to want to short because it's too far to chase. Something like SQQQ, for example, would be down, 12%. If we gap down 4 in the Qs. And so they might want to wait for that ideal objective back test of the level, which would probably never come. So that's at times, that's trading and investing. It's in taking risks inherent. Again, you want to manage and mitigate those risks, and but you cannot completely eliminate them. So let's go back to the short-term charts. Remember, it's Friday. We'll probably see some volatility into the close. So this is a 2-hour candles, 60 or 120-minute chart of NQ. There was that potential uptrend line I gave you the other day. 1, 2, 3, 4 reactions there, and now broken. You can see. I'll zoom in tight. Try to remember in the video, especially if you're watching on a phone or a monitor without good resolution, might be hard to see. So there it is. There's your fourth reaction there, and then a breakdown. So that's a breakdown. Also just took out the recent lows by a hair, just like ES I showed you, and we're getting a lot closer to those previous lows. So there's a potential for divergence, but just like during a strong rally, you keep getting potential negative divergence, but it's unconfirmed, and then it burns through. So I will recognize that, and it gives you the potential. And look, a lot of market bottoms or corrections end with test of the previous lows, and I'll tell you, more common than a perfect test of the previous lows is a quick break to wash out, pull in, suck in some more shorts, clear out the stops on the longs, and then a reversal. So again, I'd not be doing my job to tell you that's not a possibility, and if so, you can manage it. If it happens, then you act accordingly. And of course, I'll give you updates and levels to watch. Levels that really may change things. Just a brief dip and a move back above is not going to shake me out, at least not anytime soon. But again, I'll keep you posted if and when that happens. Okay, sorry I had to pause the video there. Brief distraction, trying to recall where I left off, but jumped over now to a chart of RTY, Russell 2000 futures. We're on just hourly candles here, so 3 months of price history. Again, this tracks a small cap index, Russell 2000. There's a pretty good level right about 2000. It says 2001 here, so we'll call that 2000. And quite a few reactions is what I'm looking at there on that level. We traded through it a few times, but most recently it's held, and we're testing it now. So I just showed you, for all intents and purposes, ES and NQ, the S&P 500 and NASDAQ 100 are at support. And remember, they were a hair below, but not impulsively, not by much. And the small caps are right there. So that's it. So from where this video is being recorded here, it's now 11:19. If we go close much lower today, then we've taken out some near-term supports, and that would leave then really those previous reaction lows as the next big level. And so that's what that looks like. I hit the escape key. I didn't mean to go here, but if you're wondering what that was, that's lumber futures. There was that last short right there, went down, hit this support zone 896, but it's worth noting we just recently put in right at the previous high another divergent high, and so we could get another nice pullback in lumber. But that, again, I wanted to focus on the markets here, didn't mean to. That chart just popped up when I hit the escape key. Okay, so I showed you some short-term levels to watch. I'm just looping back to the weekly chart to real quick again show you how I think things could play out here, especially if we get a break of those recent lows next week, and it's anything more than just a little whipsaw with a move back up. Again, I think the most likely scenario then would be a swift move down to my second target around the 300 level. Call it's 299.15 is where it comes in on this weekly chart. Most likely followed by a bounce, a reaction, and then ultimately, and again, we'll have to, I'm not predicting the scope or the timing of the bounce if we get it, but another move down there. Now, an alternative scenario, if things get really ugly and that level goes, anything other than intraday. Remember, if we head down to it, talk about this all the time. I call this term I've come up with called momentum fueled overshoot. When you have a bear flag, if I'm right, it's going to be pretty impulsive coming down in there. You may briefly overshoot it. So an intraday break of 299, even if it's fairly substantial, as long as it's not all the way down here, very well could see us close the day back on or above that 299-ish level, just like we did, or the week, just like we did when we briefly overshot my first target, 342 on the QQQ. Was only an intraweek momentum fueled overshoot. You can see that we're headed straight down, free falling, and then that's when the buyers stepped in. So that's where we're back to now. And there was the typical initial reaction off the initial tag, and although it's still support, you have to respect that. The fact that we've already had the bounce, the expected bounce off there, opens a door that we may or may not have another reaction there. And it's Friday, so again, they're going to keep you guessing. Probably not going to waterfall sell off today, but anything's possible. We'll see. I'll do an update at the end of the day if anything big happens, but I just wanted to kind of show you how I think it might play out. Yesterday I already spent time showing you some of my favorite trade ideas for just if you want to be diversified and simplified using ETFs and ETNs like the VIX track and ETNs and some semiconductors and a couple sector ETFs. But the rest of the video, here's what I want to show you is some similarities. So last night, I think it was last night, Roku reported. And so Roku's down big today. And what I want to talk about is just really some conditions going on in the market. You know, technical analysis, at least the way I see it, is all about identifying current patterns and developments in a stock or in the markets or in a commodity, and then you know, going back in the past and looking at similar instances when such as those are what bullish and bearish chart patterns are all about. You know, wedges and head and shoulders and cup and handle patterns and all these things, bear flags, continuation patterns, bull flags. And so what I've noted is quite a few, you know, popular stocks, including some of the biggest in the world, some of the market leading FANGs, all seem to have these, a lot of them seem to have similar patterns here where they went into multi-month, in some cases a year-long trading range, a pretty well-defined topping pattern. And here's Roku. Roku did it here. We had a bearish rising wedge, and this was all, a lot of these lines you see on the chart, I haven't changed anything. This line here at 295.23, the bottom of that range, the only thing I added recently was the box. I created that line, you can see in the pop-up box, back on May 6, 2021. I have not modified it. So I had these levels here, and you can see that was our, you know, we had a sell signal on Roku there, went down, hit that level, hit it again, and then that set up this range. And again, this is so similar. I'm going to go through many of the things that I've covered recently, such as IWM. IWM had almost the same thing here, a year-long trading range like that. And then you had a breakout. So this is technical analysis. This is what it's all about. And also where I'm going with this, I'm going to show you those that have already had such a pattern here and have broken down and played out. So for example, on Roku, that was, you know, once a crowd favorite, the stock's down 65%. Okay, so if anyone that, you know, does the old buy and hold or buy and hope strategy where you just, you know, figure over time stocks will go up, companies will go up, now you've lost 65% of your money, or you could have made, and again, that's just from the breakdown, not from the highs. You go from the highs, I have to turn off all the lines here. Roku has dropped now 79, 80%. So you would have lost almost all your money if you bought the top. Or you could have shorted that wedge break. You could have shorted that secondary. We had another divergent high right there. I didn't have that marked. I just noticed that when we put in the high. See, this is technical analysis. Divergent high again, same thing. Wedge pattern right there. Another breakdown and a monster short. Now, where am I going with that? Okay, so again, this is a common theme I want to go on, but look at the technicals of Roku. And I'd gotten away from the stock. Honestly, I hadn't looked at it in a while. See this line here at 169.83? Also, I created that line back in September 23rd, 2021. and I've not modified it. And you can see what happened. So way back here, somewhere in 2021, I guess right here, expecting the breakdown, maybe I did highlight the stock then. And that would have been a downside target. It was support. But look what happened. We shot through it. We hit it, bounced there. It was a nice support level because all these highs back here, these reactions. And you see when the stock broke it, it set up a little flagging action, and that was then resistance. Support, once broken, becomes resistance. That's TA 101. Support from below, resistance from above. And then this is what happens, and I often talk about this, how a stock heading into earnings, if I don't have a clear read on the charts, it's random whether it's going to go up or down. But when a chart's clearly bullish or bearish, that will more often than not always, but more often than not, indicate where the stock's going to go. So this one again was off my radar. This is a hindsight analysis, at least at this point. All these lines were here and the stock was covered back then, but there was your impulsive move, your flagpole, there's your bear flag, and look at that. And then right down to this support level here, 101, 171. I created that line today, added that to the board here. Might have had this one. Yeah, this one was created back in September. And then I noticed, so that was a support level I had, but then I could see definitely some reactions here. And so that's probably about it. Again, it's your measured target. And lately, I mean, you've heard me point out quite a few bear flags lately, and they're beautiful to trade. And look at this. Look at this measured target right here. What I'm doing, I'm going to see the high point of the flag right here. That's all I did. I took the flagpole, meaning from where it started dropping impulsively, the high to the bottom of the pattern right there. And I take that and you add that to the highest point. If you can't see it in the video, there is a candle right there. And look where it is today. Almost perfect. Never ever fails to amaze me. And price support. So bottom line, if I was short Roku, I would cover it today. If the market collapses, is it going to go down more? Probably, but most of the downside's probably there. 80% off the highs. Perfect bear flag measurement right to nice, pretty decent support. Again, this one may continue to work its way down, but it's all about risk reward. I'm not in it. I don't know if you are, and if you are, here's another downtrend line we can extend off the highs there, comes in there and comes right there. So probably a good time, and maybe even a bounce trade. And my God, if I was bullish, thinking the market was about to turn around in the next few weeks and break out to new all-time highs, I'd be loading up on Roku here, and I'd be looking for minimum, and still I'll throw it out as a trade idea to you, a backfill of the gap right there, and that's the bottom of the flag as well, 140, almost 143. There's your bounce target for Roku. But again, that wasn't the point. It's just to point out similarities. Netflix. Here's Netflix. You can see here in the little clear here, Netflix also had a same pattern here. Now some of these, unlike Roku never made it out, but quite a few, including IWM, had those same multi-month, in some cases almost a year-long trading range, as that one was, about a year long, close to it, maybe a little more actually. This one started back in June or July, went all the way till September. And then you had an upside break, right? And that's bullish, right guys? Breakout to all-time highs, breakout above a trading range. Yes, and then no. It was on face value, but it happened with negative divergence at the time. And that divergence caused this breakout to fail. And as I say, fewer things in trading investing are more bearish than a failed long side breakout. And we all know what happened to Netflix since. From the time it fell back into the range, that's officially when the breakout failed, the stock plummeted 40% in very short order. That's what I'm talking about. And then we gamed that. I put it on as a long right there for a bounce back to the bottom of the range. And so it was good for a quick 20% bounce. And we're back down now. So again, I'm just going over the analogies or the analogs, if you will, and comparing a lot of similarities between a lot of these market-leading stocks and indexes. So let's go back. I talked about IWM. And again, forever and a day, for over a year now, I've been harping on that trading range right there. Here, let's turn on the lines again, see if I have it boxed on a clean board. We can do it here. I'll just go back to the main board. You can see my box is in orange here, but with all the lines, it makes it a little tough to see. So that's it right here. This is one of the most beautiful patterns I've seen in a long time because it's so well defined. And there was your breakout, and again, it proved to be a false breakout, sent it right back down to the bottom of the channel, and then ultimately went on recently to break it. And so we had an objective short entry there. and then an additional objective short entry on the back test there. We're also flagging, like the major indexes. There's your flagpole, and as I've talked about quite a bit recently, I know you're hearing the same things over and over, but if you're new to the site, I laid out two targets. This initial stop when the indexes hit, QQQ hit the first target on the weekly. I added that intermediate target there, 192.15 on IWM, but this is still my primary swing target, and which was laid out long before we even broke down below the range. And then what happened after we broke from the range, we set up that bear flag, and there's that perfect measured target. Comes right in. Again, it's a measurement on the flagpole added to the top of the flag. And so if things play out as the charts indicate, it's going to take us down there in relatively short order, just like the flagpole did. And that would be still, even if you haven't shorted it yet and you short it today, that's still a drop of about 15% if it's hit. And what you don't want to see, obviously, you don't want to see now the flag can be foiled, and it doesn't mean that we're not going down there, but ideally you want to see us stay. You don't want to see a run back up to the top of the range. You could pop it briefly, you could get to the midpoint, there's some resistance, but again, ideally you want to stay below the range. And look, a little farther we go up in this range, it would then mean this was a false breakdown, and that's bullish. I'm sorry, but as of now, it hasn't happened, and I don't think it's going to happen. Yeah, the moving averages. So we're gonna, or at least I'm gonna trade this scenario unless the charts start to convince me that I was wrong, and it's not going to play out, and then I'll adjust accordingly. Okay, I've looped over now to the daily chart of SPY. I think I just moved a line here by mistake. That line probably was up there. Daily chart of SPY, and you can see once again, here's that boxed in range right there, trading range with a little, I'll zoom in a little tighter for you. Trading range there, not as long as the one in IWM, but pretty well defined with a period of false breakout right there. And again, these are common themes. So I'm going over, it may sound repetitive, but you can see what happened to Roku. You can see what happened to Netflix. So those, I think, are a precursor of what's to come here on SPY and IWM. Those that just recently broke down, back tested, and now appear to be headed lower since they failed the range. They had a false breakout, number one. So that was bearish checkmark number one when we fell back into the range. Then you back tested the top again, rejected, so your second check mark. Then a breakdown there, certainly a check mark for the bears. Multiple rejections on the back test, so check marks across the board. Starting to move lower is and impulsively lower is an additional check mark, and so that's what I think is going to happen. And again, these project because these are pretty powerful. Again, potential topping patterns here, and a top pattern doesn't usually equate to a 12% correction, and that's all we've had so far in SPY, and that's why I think we're going down lower. That's 397 in SPY on the weekly chart. I've got us coming down here at about 395. So there it is. That's your intermediate if you're a SPY trader. Swing target for SPY. And then QQQ, it's a busy chart because there's a lot going on there. I'll turn everything off or turn it back on real quick and show you the box right here. There's your box trading range. And you can turn off all the lines here and box it in this way. And so these are all the similarities there. Here, I'm going to use my box tool there. That's it. And that's when we had one little whipsaw down there, and then we finally broke it, impulsive selling, and came back up and really tested that low right there and moving lower. So that's about it. To keep going would be a little repetitive, so I won't cover them all. Just to let you know, I'm noticing quite a bit out there, and it's not just individual stocks or the indexes or sectors like XLI. This is a daily chart, but you can see that box better on a weekly chart. Here, I'll turn off all the lines. So again, common theme here. Very, very much look like topping patterns, and things such as Netflix and Roku show you what happens typically once you get a downside break. So the reason I believe the S&P 500 is held up relatively speaking is because all the sectors haven't cracked. Here's one right there. There's the industrials. You're going to need to see the industrials break down below the range, and then it should be a more of a broad-based sell-off in the markets, and that will probably bring S&P will start to play catch-up maybe to the NASDAQ 100. I still think the NASDAQ 100 will outperform, but once you see the financials and industrials and other sectors like that buckle, then that should be pretty much smooth sailing or give us additional check marks. And there's quite a few, by the way, quite a few of these broadening wedge patterns I'm noticing as well in the indexes and sectors. This is your broadening wedge pattern for XLI. So look for a break of the downside there. You have the same thing on SPY, depending on which time frame I look at. Let's see, we're on a weekly chart like we just were. There it is right there. There's a broadening wedge pattern for the S&P 500. You have this little zigzagging action going on there. There's that partial rise strategy. If you Google that, you might come across that, a partial rise on a broadening wedge pattern, aka megaphone, because it takes the shape of a megaphone like that. And a partial rise says you can short anywhere, usually about the midpoint, the 50% retracement into the of that move down. And that's probably where that one was. I just eyeballing it. Let's put up some fibs here. Let's go back, lines on. Yeah, 61.8. Yeah, you can go anywhere from the 38.2 to the 61.8. That's right, the SPY, of course, because that's where we shorted it recently, the 61.8 retracement. And that's a strategy called a partial rise, where you short a partial rise at the final stretch. Once the patterns mature, by mature, you need to have ideally 3 checks of the top of the pattern, 1, 2, 3, and at least 2 of the bottom there, and that's what we have. And there's your partial rise. And we nailed a trade years back on GDX doing that on the weekly chart. Let me see if I can dig that up. And I posted that strategy there. Let's see, it was all the way. Might be on another board. Yeah, there it is. I thought we had it. Broadening top pattern back here. This was back in 2011, 2012, and there was the partial rise. I think we nailed it right there or there, and that was again calling for a major top. And from there, even if that was the short entry, I'd have to search it on the site. It was good for about an 80% drop in the miners, and it ended the bull market, of course. And so that's why I wanted to point out these broadening top patterns can be pretty powerful stuff. And then of course there was a lot of different boards I had, but we were long the miners at that point and bullish, and there was a big divergent low, and et cetera, et cetera. All right, guys, long video, but you know my thoughts. And again, most important, react, define your trading style and your time frame so you don't overreact to counter trend bounces or breakdowns that might be whipsaws. You're either going to be actively trading, and I told you, I shared my thoughts, and I posted on the site to somebody yesterday. I'm more of this in sit tight mode now. You know me, I love gaming little zigzags. I love going down to the 5-minute charts, 15-minute charts, trading the futures, even within a larger trend of whether I'm bullish or bearish. But at this point in time, and for the last few days now, I'm more comfortable sitting tight and not trying to game any counter trend bounces, not trying to play short-term divergences or bounces off trend lines, because I don't want to be, I'm talking to my trend or swing positions, because I don't want to be caught long or not short on a quick swoon down. When I say a quick swoon down, the market can drop in a matter of percent or more in a matter of seconds nowadays with the electronic trading, and things go fast. And so, like I said, we all have to make a decision by 4 p.m. today or by the end of the day, whether to go home long, short, or in cash, or a little of both, diversified, how much. And so that I'll have to leave up to you, whether you want to take the risk of a gap for or against your positions over the weekend. But you guys know the levels to watch, and you know my thoughts. So let's wrap it up here. And if anything big develops between now and the close today, I'll do another update on the markets. Otherwise, I may get an update out on some individual trade ideas, and also might shut down today and get a few things done and check back around 4 o'clock today. This has been Randy Finney with Right Side of the Chart. Have a great day.